It's that time of the year when the annual CLSA conference is on in India, and on the sidelines of conference we always get an opportunity to interact with none other than Chris Woods. Now Chris needs no introduction. Over the years I have tracked him as a market commentator, as a financial journalist. He's always been an India bull, very vocal about why he's liked India in the past, and he's someone who has got a fairly accurate rate of getting the long-term picture and the macro trends right. Chris, welcome to India, and fantastic to have you back on ET Now.
Thank you.
Chris, if I look at the current market positioning, a lot of volatility has come back. We've seen a wild swing in crude, a big crack in some of the FANG stocks, a gut-wrenching volatility in emerging market equities. What's going on in the world? Why are there so many asset classes which are just going helter-skelter?
Oh, no, I just think this is a consequence of basically the monetary tightening cycle, which is in place for some time in the US, starting to kick in. We saw the most high beta asset class cryptocurrencies hit first, then it rolled into emerging markets, Asia, and then of course the US equity market at the end of last quarter was last man standing, as I described it, and obviously we saw the correction move into US equities, and we've seen significant technical damage done to the market leader in this whole US bull market, the FANG stocks. So my base case is, so long as monetary tightening is continuing, we have a risk of more corrections, but I think there's a significant possibility that we have a counter-trend rally interlude if my base case is correct, and my base case is we will get some type of China-US trade deal before the next wave of tariffs are due to be implemented in January.
Chris, so how would you currently map the risk-reward ratio for equity as an asset class? There is a looming fear of trade war. The Trump administration may not be all that powerful after the recent bout of election, and China also seems to be, reaching that proportion of macro mess. So are we in for tough days, better days, or flat days for equity markets?
No, in the short term, it depends on whether you believe there's going to be a trade deal at this G20 summit or not. If there's a trade deal, then we can get a decent counter-trend rally into year-end, which will be led by Asian equities outperforming, because Asia is the market that's been hit most by the so-called US-China trade war. If, however, I'm wrong and there isn't a trade deal between US and China, then it's just bearish. So I think on the 2-month view, it's all about the trade war. But but let's say I'm right, we get some kind of trade deal between US-China, there will be a counter-trend relief rally. But it doesn't mean to say we're out of the woods completely, because we still have US monetary tightening going on. But at some point next year, my base case is that US monetary tightening ends, the dollar peaks out, and in my view, the Chinese economy is still okay, and therefore I believe emerging market outperformance can resume. And next year, from an Indian standpoint, I'm hoping, my base case is we finally see more concrete evidence of the long-awaited capex cycle in India.
Chris, you've always been a long-term believer in India. But when we met last in India for the Birla conference, which was in April, you had reduced your overweight positioning in India, and then Indian markets have come down after that. So after this correction, and given that we've seen a 10-15% correction across the board now, what is your India view?
Well, I'm still overweight India. Yes, you're absolutely correct. I started the year triple overweight India. I reduced it to double overweight. Actually, India was performing better than my base case expectation in the first 8 months of this year. But then we had this shock of this default of a AAA rated company, which clearly triggered some significant downside, which obviously that was not my base case. I didn't know that was going to happen. But I'm retaining my double overweight. I think it's too late to reduce positions in India. But based on my base case that the Modi government gets re-elected next year but with a reduced majority, and that we get evidence of a capex cycle, I would be looking to raise my weightings early next year.
Yeah, would you be considering increasing your overweight position in India only after elections, or the earnings and the capex signal are good enough for you to consider your position?
No, ideally I'd like to do that early next year. Right now, though, we're going to get a lot of noise, political noise in India. We're going to have these state elections this month. The media will want to depict them as being relevant as signals for the next year's election. My view is that exaggerated. These state elections are primarily local events. So in my view, these state elections are not going to tell us much about the general election next year, but they are going to create a lot of noise. So I think by the first quarter of next year, the political landscape should become clearer.
Chris, for the longest time I can remember, and that's about 3 years plus, you've been making a case that the tough or the curveball for Indian market is that the capex cycle is not picking up. But now there is evidence of that. NPAs are getting sorted out. Companies like L&T, they've come out with good set of numbers.
Yeah.
So are you confident that the capex cycle has picked up or is about to pick up?
Now, I'm increasingly confident that it's already started to pick up. The problem from a macroeconomic standpoint is that all the top-down data in India has been kind of heavily distorted by these two shock events, or not, well, shock event in the case of demonetization, and second, structural reform event in the case of the GST implementation. So that has made it harder to read the data series. But I completely agree with what you just said, that the indications are that the investment cycle is on the point of turning. And I think the resolution of some of these NPAs is a hugely significant and constructive development.
Chris, you've always maintained a very positive outlook towards Indian HFCs, the Indian home finance companies. But given that we've seen tightness of liquidity for the NBFC sector per se, do you think the outlook for NBFC sector could be slightly fragile, especially HFCs?
No, clearly the growth is going to slow in that area as a result of the ramification shock waves from that AAA credit defaulting. That's very unfortunate because it's going to basically, at least temporarily, remove or destroy investors' confidence in credit ratings. So clearly there will be more of a slowdown than previously anticipated, but equally clearly a lot of that slowdown has been probably more than discounted in the sharp sell-off. My hope is that the worst has been seen in this area. I think it's encouraging, I wouldn't put it stronger than that in October we saw some renewed inflows into the bond funds after the big stampede out of them in September. We still, in my view, on a situation where the residential property market's in an early stage of a recovery after an extended downturn. So I'm telling investors to own the quality property stocks that will benefit from the healthy consolidation of the residential property sector, which will be the consequence of the double whammy shock of demonetization and RERA. And the other area I would be using advantage of the recent correction to add to exposure is the affordable housing area. So the affordable housing program is kicking in on the ground in terms of the delivery of affordable homes. That's a long-term growth story which is very positive for those companies exposed to it. It also should be positive for the government in terms of them getting re-election. The more visible evidences of this affordable housing program becoming a reality in the terms of the final delivery of affordable homes.
So in your book, the current downturn in NBFCs and especially HFCs for a long-term investor is a good buying opportunity, and one should be buying the fear rather than getting scared from the fall?
Oh, no, absolutely. No, I definitely think that. But there is a technical issue which we can't ignore, And that technical issue is that the legitimacy of the credit ratings has been badly damaged, if not destroyed, which my guess would mean that the market is now going to pay more attention to the parentage of these companies because they don't trust the credit ratings. And there's a regulatory issue of what the regulators are going to do to address this area, because clearly this is not an area the regulators warned about before the problem happened.
Chris, in a note which you'd written in the month of Feb, immediately after the budget, you'd raised concerns that after the imposition of capital taxes, the domestic inflows into equities will slow down. But frankly, the trend has been very strong and domestic institutional investors are still pouring in money via the SIP route. So how does this change the equation for markets and especially for liquidity?
No, that's good news. That to me is a pleasant surprise. So the unpleasant surprise in India was the bond default. The pleasant surprise this year has been the equity inflows have been maintained to a greater degree than most of us was expecting. So that's a positive because foreigners have been selling, and that's just plain good news because it makes the stock market much more resilient. So yeah, that's a positive surprise. But I think the key issue right now is not the equity funds; it's the bond funds, given what happened on the NBFCs.
And what is your view on the way bond yields currently are in India? Because we are no longer close to 8% plus. The bond yields today have come to a 7 or 8 week low. So do you think the interest rates in the system per se currently are settled?
Well, I've been telling investors that if you can buy, especially foreign investors, that if you can buy the Indian 10-year bond yield at 8% or higher, that's a long-term very good value and you should buy it. Amidst all this noise we see right now in terms of the seeming controversy I've read about since I arrived here between the central bank and the government, the key practical point is that the central bank has been running a very tight monetary policy. My understanding is the central bank's targeting headline inflation. So based on headline inflation, you have had very high real interest rates in India, which in the long run is positive for bonds because that is basically deflationary. I think there is a very legitimate argument that the central bank has been too tight in terms of the high level of real interest rates. Clearly core inflation is higher than headline, but my understanding is that the RBI's formal target is headline, and the fall in inflation seems to be partly driven by a significant decline in food inflation, which seemingly reflects a long-term positive improvement in agricultural productivity. Yeah, so the bottom line, in my view, 8% on the 10-year bond yield, in Indian government bond yield, is good value. And obviously it's a bit lower than that right now. In my view, the big risks in India in the next year are primarily external, and they're basically outside this government's control. One is the oil price. So India's been lucky because Donald Trump did a U-turn on the policy on Iranian sanctions, and that's the only reason oil's corrected in the recent weeks. And so I still think there's a real risk that oil trends higher in the next few quarters because of the lack of supply. And the second issue is the dollar. So I'm hoping the dollar peaks out next year when the Fed tightening stops. But for now, so long as we're looking in America at the current combination of fiscal easing and monetary tightening, we have a risk of further dollar strength. So those to me are the two key risks for India, and they're both external.
In your model portfolio, one very interesting addition is Reliance Industries. Not because Reliance is not a known stock, but you're classifying that as Indian Internet. So this is for the first time I have seen an official recommendation in your model portfolio, and you're calling Reliance as an internet company. So to your mind, are you trying to say that Reliance has potential to be the Alibaba of India?
Well, I'm not sure. Yeah, I'm just basically saying if you were looking for a big cap digital play on rising digital e-commerce, rising transactions over smartphones. That's the best big cap play.
Chris, you also were quite constructive on commodities at the beginning of the year. You included a couple of global resource stocks in your portfolio. What is your view on commodities at this point in time when the fear of trade war could have impact on global growth?
Yeah, no, I'm not, on the trade war, I'm hoping they do a deal because I think Donald Trump will want to do a deal. But on commodities, yeah, on oil, I think the risk is it goes higher because of supply constraints and strong emerging market demand for oil in countries like India. So to me, the risk for oil is demand destruction, but that risk has just been reduced because the oil price has gone down. And on commodities, industrial commodities, I'm kind of neutral because while I'm not super bullish, I'm not super bearish because the capacity shutdowns in China from 2016 has led to a reduction in excess capacity in industrial commodities, which in my view makes industrial commodities more resilient. My base case is that we do not get a recession in the US next year. In my view, we only get a recession in the G7 world if we get big asset price declines. So the economy will be driven by the asset prices, not the other way around.
Chris, the joker in the pack, some would argue, could be the dollar index, because the dollar index is now nearing towards 100, and it's not happened for the first time. It's gone way below 100 in the past also. Is that the big elephant in the room which could change the global setup?
Yeah, we had a major spike further higher in the dollar. That would definitely make more deflationary dynamics. So far, while the dollar has rallied this year, the fact is that the last time we had this unusual combination in America of monetary tightening and fiscal easing, which is what we have today. The last time we had this was in the first few years of Ronald Reagan in the early 80s. At that point, the dollar went way higher than it is today. So given we've got the Feds by a long way the most hawkish central bank in the G7 world, and more hawkish than most emerging market central banks, actually what's surprising is the dollar has not rallied more.
A couple of weeks ago, Chris, we had Ray Dalio, world's biggest hedge fund manager, on the show, followed by Howard Marks. And the sense which we're getting from some of these classic investors is that American markets are due for a correction, the sugar rush is going to fade away, and one should be cognizant of risk, and one should diversify. What is your view? You think it is time now to diversify and be cognizant of risk, because equity markets have enjoyed a very long purple patch of 5 to 7 years?
No, I think that was common sense since the start of the year, simply because the longer monetary tightening goes on, the bigger the risk to equities. So we've got to remember we've got a double whammy of monetary tightening in America. We've got Fed rate hikes and Fed balance sheet contraction. So actually the only surprise to me is that the correction took so long to happen in America. So as I said, at the end of the third quarter, I described the US stock market as the last man standing. So I think that's just common sense. But we need to understand why the US market was so resilient, and that is the dramatic impact of tax reform. Donald Trump's tax reform was extremely bullish for US equities. It's driven a significant pickup in earnings growth because there were significant cuts in taxes. And it also led to statistical proven evidence of a big repatriation of money held offshore by American corporates in the form of dividend payments back home. And it's quite clear that that big inflow of corporate money has triggered a whole new surge in share buybacks. So in the first and second quarters of this year, there were record high share buybacks, and that's the key reason for the US market outperformance. And we need to remember that American corporates have been the biggest net buyers of US equities since 2009.
Chris, we've seen sell-off in Chinese internet stocks. We've seen China mainland stocks have also corrected. Now, historically, India and China have always competed for foreign flows, whether it is FDI or FII. Given that there are challenges both at economy level and also, at a stock market level, do you think India becomes the only game in town where large allocations could kick in, and that in the margin will ensure that Indian markets will not correct substantially?
No, I think foreign investors should be looking to buy both China and India. In fact, I would buy China before India right now because China is much cheaper. And China market has had a lot of domestically driven forced selling because of the Chinese government's deleveraging campaign. So actually China is more interesting short term than India. The Americans think that the weakness of the Chinese stock market this year is driven by the Trump administration's trade agenda. That's completely wrong. The weakness of Chinese stocks this year is driven first and foremost by collateral damage from the Chinese government's campaign to squeeze out the excesses in shadow banking. This is long-term, very positive policy in China, but it's definitely creating collateral damage. You've had a lot of shares pledged in by private sector companies, owned by chairmen of Chinese private sector companies, and you've had a lot of forced selling. Anytime you have forced selling of equities, it creates a long-term buying opportunity. That's what you have today in the Chinese market. So actually China, I would buy China today before India. I'd buy India more aggressively, as I said, first quarter, but I'd be overweight both.
Chris, final question, and we'll not stretch our appointment after that because you've got to get back to the conference also. Your clients waiting there. Chris, every time when we see a large correction in global financial markets, parallels are being drawn between 2008. Do you think this is not 2008, and even if markets correct, the intensity of the sell-off would be a rather measured one, and we are unlikely to see a repeat of 2008 anytime soon?
No, I don't think it's a repeat of 2008 in terms of, but I do believe there is a major risk of a correction in the US which is triggered by technical factors, which could lead to a much bigger sell-off than warranted by the fundamentals. And that is because of what I call the Terminator effect in the American market. And that is the reality that up to 80% of trading in America is now done by machines. And these machines are running on these algo-driven trading models. My guess, although I can't prove it to you, is that most of these trading models are all based on the same simple methodology, which is some version of what is known as risk parity. And the underlying assumption of all these trading models is that when equities sell off, government bonds rally. So what you need to trigger a massive technical unwind and blow up the machines is bonds and equities going down together, i.e. positive correlation on the downside. If you had 2 months of that happening, I think you'd get a massive technical unwind on Wall Street, which would look very horrible, but it would be primarily technical.
Chris, such a pleasure to have you back on ET Now. Certainly hope to see much more of you going forward, and thank you for your time. Have a wonderful stay in India.
Thank you.